The deal market is buzzing with a spate of mergers and acquisitions being announced by India Inc. Starting from PVR Inox to HDFC Bank, the Indian corporates have seen big names announcing mergers. And the list doesn't end here. Larsen & Toubro Infotech and Mindtree could be the next in line, while JSW Group, Adani Group, Ultratech Cement and Shree Cement have reportedly shown interest in acquiring Holcim's Indian assets. Wipro Limited has also announced acquisition of SAP firm Rising Intermediate Holdings. On the board says, shares of these companies have remained volatile, reacting to every news flow. But the key questions remain as to why is there a flood of M&As right now and how can investors benefit from them. According to Dinesh Arora of PwC India, the trend underlines India Inc.'s cash-rich companies' desire to expand and eye inorganic growth.
What has happened from the demand side, let's start first, that 2020 was the year when a lot of companies went for cost cuts and reducing their overheads and increasing efficiency. What that has led to is very high availability of cash with the companies, and therefore we have a set of people in the country, set of companies in the country which have got cash available for expansion. 21 was a year when people started investing in growth. So people from mindset perspective are ready for growth, and from availability of funds perspective they have availability of capital. The second thing which is on the supply side is which is a problematic thing which has happened is that lot of companies after COVID were not able to improve their situation, and therefore they are still struggling, and therefore they want to get out of the business, or they need to find a person who can take over the business. The second thing is also, which we have seen in some of the Indian promoters, is they are very much amenable. Their priorities in life have changed and they are amenable to selling out. So that speed has also increased. So these macro factors, I would say, on the demand and supply side are driving the pace at which and the volumes that you are seeing in the market as of today.
According to a report by Refinitiv, M&A activity hit a 4-year high at $30.3 billion during January-March quarter of 2022, bucking the global trend where deal making fell sharply. Deal activity grew by 5.6% year-on-year in value terms in the first quarter of calendar year 2022, making it the highest quarter period since 2018 when it was $31.1 billion. In volume terms, the M&A activity grew 29.6% YOY, making it the best ever quarterly number. Yet, Utkarsh Sinha, Managing Director at Bexley Advisors, says India Inc. has a long way to go in terms of maturity of M&A activity.
The first wave of M&A is almost always driven by horizontal mergers. The idea is to get growth in scale and a reduction in competition, reduction in the cost of acquiring customers. The second wave follows after that, which is more of vertical mergers, where companies try and integrate into their supply chain and make sure that they're able to drive some reduction in costs. That is followed by a third wave, which is conglomerization, which sees the rise of companies like General Electric, or in India, Reliance to a large extent has experienced that. The fourth wave is driven a lot more by financial sponsors. So it's private equity, LBO driven, and it's oriented on unlocking value. It's oriented on delivering returns. And the fifth wave is finally mega deals, where companies start crossing their border acquisitions. They start they start having global aspirations. India is still in that first wave. On a larger perspective, on a macro level, India is still very much in very early stages of the M&A boom, and I think a lot of that is driven by the fact that we do not yet have a very mature capital market in India. Whether it's the public market or the private market, the amount of money and the amount of and the number of players in that space.
Sinha says the recently announced mergers fall in the horizontal M&A category, which is driven by saturation in scale, aspiration to grow via absorption of competition, or driven by individual sponsors or investors. So, if you wish to benefit from these M&A activities, here's what you need to be mindful of.
Investors will have to be cautious that not all mergers and acquisitions are driven by choice. Some of them are forced. Some of them are just for very defensive reasons. And these mergers will not create value or as much value that investors would expect to translate into their returns. So even long-term investors will have to very carefully assess the real reason behind a merger and the potential upside, and also the risks of the mergers not working out.
That apart, investors should assess each M&A deal based on synergies and valuation.
Even way back in 2000, the Satyam Mehta's fiasco has taught us that shareholders have been quite active in understanding that they can't be easily fooled, and they are quite open to opposing deals that are detrimental to their interests. So, but again, this doesn't mean that every merger is against the shareholder interest. We need to look at every deal individually, and investors must definitely avoid taking positions based on initial news announcements.
In nutshell, deal-making activity including acquisitions, divestitures and alternate M&A strategies will be robust in 2022. Investors, however, need to be patient and look for long-term benefits before betting on them. On Wednesday, stock-specific action amid March quarter earnings will drive the markets. Bajaj Auto, HDFC AMC, HUL and Indian Hotels are some of the prominent companies slated to report their quarter 4 numbers. That apart, global cues and cabinet decisions will guide the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.